Okay. Hopefully everybody can hear me now. We are doing a short 30-minute webinar here on hiring an investment banker or broker. And the way I'm going to be talking about this today is in the context of a sell-side M&A advisor or intermediary. And so either a business broker or investment banker that is hired to help with the sell side of a M&A deal, and also kind of talking in the context of a mid-market deals, just because that's the area we play in. And so that's where my experience is in. And so most of my comments come from, hey, this is somebody you're hiring for a mid-market deal. Mid-market deal can mean different things to different people, but in my context, I'm using that as $1 million to $50 million range of the sale of a business or transaction value. All right, so let's go ahead and get started here. Just a little background on me. My name is Trevor Crow. I'm one of the founders here at Crow Legal, and we're a business transactional firm. And we focus strictly on, like I said, business transactions, whether it's M&A, mid-market M&A deals, private securities offerings, or startup entity formation. All of our clients are entrepreneurs in some fashion, and we like to help them solve complex business problems. And that's what we do. We have 8 attorneys, and we're all laser focused on those areas. So that's just a little bit about my background, but that's not why you're here. You're here to learn about the topics. So we'll jump right in. And first, we have the agenda. We're going to be talking about the differences between an investment banker and a business broker. Talk about when you might be looking for either one of those as a M&A intermediary. And next, we're going to talk about what to look for when you're hiring an M&A advisor. And we'll talk about the types of fees, and then potential pitfalls to look for in engagement letters. So that'll be the agenda today. We can open it up for questions as well. If you have any questions, please put them in the chat. I think that's the best way to do it, is to put them in the chat, and then I'll look and review those as we're going, and try to answer those questions as we go. So feel free to put those in the chat at any time, by the way. Whenever you have a question, go ahead and just put it in, and then I'll answer it as soon as I see it. All right. So let's go to the next one. All right. So investment bankers versus business brokers. So biggest difference in my mind is the deal size, which is the second bullet point there. And so typically investment bankers are going to be doing larger deals, whereas business brokers are focused more on smaller deals. I put this 7 million number as kind of the breaking point of where business brokers and investment bankers start to look at deals. Some people, I've looked out there on other resources of what other people thought, and some people have that at 5 million. My general experience is that 5 to 7 million is kind of the mid-range, where it could be either a business broker or investment banker. So that maybe that there's a little bit of overlap there between the 5 and 7, but in general, you're pretty safe once you get over the 7 million that you're probably looking at an investment banker, and if you're looking under 5 to 7 million, then it's probably more like a business broker that's going to be helping with the deal. What kind of licenses do they have? Well, most investment bankers are going to have securities licenses because they are dealing with securities. Oftentimes, whether the deal is structured as a stock sale, or sometimes they help just companies raise money and other things like that. And so since they're dealing with securities, they typically have securities licenses. Business brokers, it depends state by state, but for example, in Colorado, business brokers are required to have a real estate license, and so that's mainly the licensing requirement of most states for business brokers, is just to have a real estate license. Fees can be a little bit different. Oftentimes, business brokers are just working off a success fee, maybe without a retainer, whereas most investment bankers are going to have some sort of retainer and success fee. And then, the way that they market the deal is going to be a little different, or can be different. Investment bankers oftentimes will have controlled auctions, and when they go to market with a business that they're trying to sell, with a very limited number of, or maybe not a very limited, but a limited number of potential buyers that they're strategically going after to try to create multiple offers that helps increase the transaction value. Whereas oftentimes business brokers are doing more simple marketing, or I say simple, it's not necessarily simple, but it's, putting it out on Business by Sell or Biz by Sell or other websites that have businesses for sale, and they're reaching out to their, contacts of buyers and that sort of thing. So that's the kind of marketing that I typically see with business brokers. So those are the big differences there that I've highlighted here. And again, I think in choosing between the two, the biggest factor is going to be the deal size. So what size of the deal, transaction value for the seller, and that's going to usually dictate whether you're going the investment banker route or the business broker route. All right. So what to look for when you're hiring a business broker or a investment banker, and I'm just generally going to be referring to that as an M&A advisor or an M&A intermediary. And the first thing to look for is what is their track record. In my mind, I think that's the biggest factor. And really what I'm saying by track record is how successful has this person been at closing deals? Are they a deal closer? Are they a deal maker? And so that's the biggest thing. So, have they been able to close deals in the past? Or their team, it could be that they work with a group of people that has closed deals in the past. And so that's important to know. The second biggest item to look for is the experience with the transaction size. So, not only is the advisor a deal maker, but do they have they done deals in the size of transaction that you're looking to sell? So if you're owner or CEO of a company and you're looking to sell and you're looking to hire an advisor, and let's just say you put the transaction value at around $10 million, has this intermediary sold a business for $10 million? And have they been involved in those type transactions that have closed? And that's an important characteristic that you want to look for when you're hiring a business broker or investment banker to help with the sale. The other type kind of goes back also to whether you're going the investment banker or the business broker route. A large, as an extreme example, a large bulge bracket investment bank like Goldman Sachs or something like that is not going to be a good fit for a $2 million sale, right? And vice versa, a business broker with a real estate license is probably not going to be the best person to help with a $50 million transaction. And especially if their career has been selling laundromats for $150,000 a pop, or more of a Main Street type broker. So those are things to look at. And that experience is important because how you market the deal is going to be different. How you market a $1 million business versus how you market a $20 million business is going to be different. And so you want to make sure that the person that you're hiring has experience with that transaction size. So assume you have those two. You have a deal maker, you have somebody with the experience in that transaction size. Then I think you look to industry experience. So does this person, if you're choosing between other things being equal, if you're choosing between an intermediary and one has the industry experience or expertise and one doesn't, then that's a good sign to go with the one with the industry experience. Sometimes there's nuances with businesses in different industries, and if they can help highlight those unique characteristics of this type of business in this industry, it helps with marketing. It also helps with structuring the deal and finding qualified buyers. So oftentimes industry experience can be a big help for when you're looking to hire a intermediary. Now, I put it as third on the list because I do think it comes below the other two. You really want somebody who has the track record and experience with that transaction size first, And then, if you have those two things, then look for industry experience. And then lastly, I put location. In this one depends on the size of the business and it's how big the business is and its own geographic scope, right? So if you're looking to sell a business, if most of the buyers for a particular business are likely going to be somebody local, either a local strategic company or a high net worth individual that lives local because all the operations are local, or it's a sale to a local private equity type company, then a local intermediary is probably going to be the best fit here. Somebody who's XYZ person from big city may have some enticing background and experience, but you got to really think whether that person is going to be able to come in and sell this business if most of the potential buyers are going to be local to the area. So that's something to take a look at is where are they from and are they going to be able to tap into the potential buyers if location is going to be an issue. Now, on the flip side of that, if the company is a national company, it does business all across the United States, for example, even internationally, then your source of buyers has just increased. And so then the location of your advisor is less important. And so going out to finding somebody from, like I said, I gave the example of XYZ big city, but on the east or west coast could be a better fit because they may have a lot of experience with potential buyers that are buying national companies. So something to think about there. All right. So what is your advisor looking for? You're the CEO or the owner of a business and you're interviewing that advisor, but that advisor is also interviewing you. And so I would say the top three things that they're looking for when engaging a client is that they want to make sure that the client has a reasonable expectation of value and is also committed to selling, right? That's a big thing for them, is that you're actually committed to selling, because the biggest part of the fees come on the back end when a transaction is closed. So that's the first one. Second is the business attractive? Is it a good business and in a good market? Is it in an industry that's selling hot right now? And is the business, have good financials and things put together and systems and process all buttoned up? Those are all things that help make the business more attractive for a sale. And then lastly, they're going to look for the ability to work with the principal owners. Do they have do they vibe well together? Is there, are they able to work together collegially and to help through this deal? Because, the M&A process is a roller coaster ride, and they know that they want somebody that they're going to be able to spend a decent amount of time with and have good conversations with, good and productive conversations as the deal moves forward. So that's, just wanted to add that in the slide here. So, you kind of have some thoughts on what these advisors might be looking for when they're also interviewing potential clients. All right. So how do you do due diligence on these, on potential business intermediaries? Again, whether it's investment banker or business broker. Some of the things that I put down here that I think are good is, one, ask for referrals from other service providers. We've worked with, at Crow Legal, we've worked with many very good investment bankers and business brokers. And so, we would certainly be able to put you in the right direction if you had a question on, who should I go with to help sell my business? We could provide some recommendations, especially if it was local to Colorado. CPAs, other service providers may have other recommendations as well, but I think that's always a good place to start, is to get referrals from other service providers if you don't have connections already. The second is references. Checking references, and references can be you can either request them from the potential business intermediary that you're going to hire, or what you can do is just go to their website or look at their social media profiles and see what deals that they've done. All or most M&A intermediaries are going to post that they've just sold another deal, or this company got acquired by this company with our help, and they're going to put these tombstones out there and market the fact that they've just sold a business. Same as, real estate agents, you get the flyers, oh, this house just sold, or whatever, to show some credibility in their ability to close on transactions. But usually the names are there, so you can look and see, this company just bought that company, and if they were the sell side advisors on that deal, call up that company, call up the prior owner of that company and say, hey, how did it go? So sometimes the unsolicited calls will get you the best information. Obviously the business intermediary is going to, when asked for references, is going to provide those that they believe are going to give you the best reference out there. So sometimes it's good to call those people, but also call some of the people that aren't on the list that you can find through just a little bit of research on what deals that they've done in the past. And then third, I think interview multiple advisors. It makes sense in my mind to interview at least two, but 3 or 4 would be better, to just get an idea of how you think you can work together and what their process is, how they plan to go to market, and just get some general ideas on how they plan to market and sell the business, and what services they'll provide for that. And so I think those 3 things are helpful when you're performing due diligence on a potential M&A intermediary that you're looking to hire. All right. Let's see here. All right, so fees. Let's talk about fees. What are the fees that the business or the M&A intermediaries are going to charge? Well, these can fall into several buckets. First, we have retainer fees. Then there's a success fee. You have expenses, and potentially a termination fee. And so we'll talk about these. So a retainer is typically used to show a couple of things. A retainer fee, if a M&A intermediary is asking for a retainer fee, they usually want, one, to show that the seller is committed to selling and to the M&A process. So, are you just kicking the tires, or do you actually want to sell? And so that retainer fee kind of shows some commitment to selling. 2, it helps pay some initial costs, right? So the marketing of a business, plus all the time spent in reviewing financials, preparing decks for marketing and things like that, there's costs to that. And so the retainer fees are going to offset some of those initial costs. And third, a lot of times, sellers see this as motivation to the business intermediary to actually work on this deal, right? So if you have a retainer fee up front, that gives them more motivation to keep working on the deal, because they're getting compensated for their time spent. So that's something to look at, and that's the typical range for retainer fees can be $5,000 to $10,000, and that's for mid-market deals. Obviously, if you get much higher, then those fees can get a lot higher as well. All right, so that's that. I would say from the sell side, I always, when we've had clients come in on the sell side and they're looking to retain an M&A advisor, they may be worried about this retainer, and oftentimes I say, well, consider how much time they're going to spend on it if they don't have that. So I do think that the retainer fees can sometimes be, as long as they're reasonable, can be a good way to make sure that your intermediary is going to be helping, really pushing your deal forward. All right, next is the success fee. So success fee is the percentage of the transaction value, and it is paid when the business is actually sold. So defining these terms, we'll get into that when we talk about engagement letter issues, but typically, like I said, it's going to be some percentage of the transaction value. But it may not be that simple, because the transaction value can depend on a lot of different things, and sometimes the devil's in the details on how the engagement letter is structured. But again, we will get into that here in a later slide, but this requires a detailed review of the engagement letter. Business brokers, typical range between 8 to 12%, I would say, with 10% being most common on the transaction value. And so that's probably the most common range of fees that we see there. On the investment banker side, a lot of times you hear this term, the Lehman success fee or the double Lehman. And so that's some percentage, some sliding scale of a percentage that goes down. So 10% on the first million, 8% on the second, 6% on the third, 4% on the fourth million, and then 2% on every million after that. So that's a typical scale that is often used for investment bankers. And this is all subject to negotiation. So sometimes there are sliding scales with business brokers. Sometimes there's different sliding scales for the investment bankers as well. And so this all can be negotiated in the engagement letter. All right. And then next is expenses. So certain expenses may be listed in the engagement agreement as reimbursable to the intermediary. And these reimbursable expenses, they can be negotiated in that in the engagement letter as well. So what actually gets reimbursed and when is definitely a negotiation point. So something to look for in the engagement letter to see what you're going to have to reimburse the intermediary for, if anything, during the transaction. And then lastly is a termination fee. I put this in here, but this is very rare for a mid-market deal. Typically, it only applies or should only apply if the seller receives a reverse breakup fee from a potential buyer. So a contract is signed, and if you had a reverse breakup fee provision in there, then the potential buyer, if they don't close, may owe some money to the seller. Those are very rare in and of themselves in mid-market deals. So I put it in here, but again, I think it's very rare to see a termination fee or a reverse breakup fee in a mid-market M&A deal. All right, let's see here. Next, so other fee issues. So there's also timing for payment. This is negotiated in the engagement letter as well. From the M&A intermediary side, they're going to argue and push for getting payment for everything at closing. And so they receive full payment at the closing of the transaction. But, as I mentioned before, a lot of times these transactions aren't so simple. So, what if there's an escrow holdback or something like that? Oftentimes you can get, the engagement letter revised to say that there's a discount on any escrow or holdback fees and things like that. So anyway, just some things to look for in an engagement letter, that this timing of payment issue. And we will talk some more about that in the next slide as well. And then lastly, I have the tail period. So the tail period is a period of time that begins at the end of the advisor's engagement. And so as soon as that's terminated, without a completed transaction. So usually these engagement letters with M&A intermediary says that it can be terminated at any time by either party. So, I'm the seller and I hire an M&A advisor and we enter into an engagement letter. I can terminate them 30 days later with just written notice to say, hey, I want to terminate the engagement. So the tail period begins then. And so if it's before a completed transaction, then there's usually some sort of tail period. It can be anywhere between 12 to 24 months. And what it does is it says that, hey, if a transaction is closed, so if you do end up selling your business within that tail period, then you may owe fees to the M&A intermediary. So if they brought you a potential seller and you start to negotiate, but there isn't an agreement in place, and then you terminate the M&A advisor and then go close that deal with that seller, with that buyer, 8 months later, they still are entitled to their fee, is what that tail period does. And that just prevents, people from terminating at the, eve of a deal getting closed and trying to avoid paying the fee. And this is a highly negotiated provision in an engagement letter with an M&A intermediary. And so both the timing of it and then, what is the criteria for that M&A advisor actually getting paid. And so is it just for sellers that they've introduced? Is it, sellers that they've introduced plus other people just because they've created this marketing effect? That's all highly negotiated in the engagement letter, but certainly something to consider. All right, we're running out of time here. I know we just set this for 30 minutes, so we're gonna, we have one more slide, and that's the engagement letter issues. So first thing to think about is what are the scope of services? You know, from a sell side or CEO or owner of a business looking to sell, you know, you want to make sure that that scope of services includes all the services that you want the advisor for, right? So is that reviewing sellers' financials, doing industry analysis, putting together marketing materials, approaching potential buyers, you know, all those sort of things. You want to make sure that that's detailed in there, so there's no ambiguity on what they're supposed to be doing. Second is this definition of a transaction. And so transaction is when they get paid, and when the M&A advisor gets paid is when a transaction occurs. Now, these terms could be a little bit different depending on the engagement letter, but in general, I see it defined as transaction. And you know, if you're a seller, you want to really look at what that is. Is a transaction only 100% sale of the company, all of the company's assets, or could it be the sale of capital stock or an investment or a or merger, some sort of reorganization, or just some private equity investment? What does the transaction include? Now, obviously, from the investment banker or business broker side, they're going to want to define transaction as broadly as possible. You know, if you're the CEO or seller of a business, you want to take a look at that and see if you need to tailor that a little bit better. Next thing is fees. We discussed those in prior slides, but the biggest thing there is, I think, is transaction value. So there's usually a defined term for the success fee that says they get paid on a percentage of the transaction value, and you want to make sure that that covers only the consideration and not, you know, additional value that might be attached to collateral agreements like guarantees, leases, transition services, things like that. This is the really biggest issue, I would say, in these agreements to take a look at. You know, I've seen some very greedily worded engagement letters, you know, where things like, say the company just had a bunch of cash that it kept in the business and didn't distribute out to the owners. You know, it's sitting on $2 million of cash, which is not needed for net working capital. But the agreement says that any retained assets are also included in the transaction value. And so really that's just money that could have been distributed out at any time. It's not going to the buyer or anything like that. But the way the engagement letter was worded in that situation that I'm talking about, that was included as transaction value. And so they were supposed to pay a fee on that $2 million that was, like, again, just sitting in their bank account. So beware of what how that's defined. You know, also think about what could be different in the structure of the deal. Earnouts. Do you get paid on the earnouts, and timing of that? Is that at closing or only when received? You know, what happens if there's indemnification claims? All those sort of things are things to think about, because that's really where I think you can make the biggest mistakes on or be set up for a big surprise at the closing table when the fees that are claimed by the business intermediary are much higher than you expected. And then a couple other things in there, you know, confidentiality. Usually you want to limit, there's some confidentiality provisions between the parties in there, exclusivity, you know, or do they have exclusive right to market the business, that, you know, and the business intermediary is going to ask for that, which I think is fine and pretty typical, but sometimes there are situations where exclusivity shouldn't occur, and you might want to look at that. And then term and termination, you know, we kind of talked about that, but typically these are can be terminated by either party just by written notice. And so I would say take a look at that to make sure that, you know, that aligns with what you're thinking the transaction will be, or how you may engage or disengage with that business intermediary in the future. All right, that's it. It's a whirlwind tour of hiring an investment banker or broker, all in 31 minutes here. So I'm hoping everybody got some value out of this. I don't see any questions in the chat, but if you have any, please let me know, or please put them in the chat. I'll wait around here for another minute here to see if anybody puts in a chat. Otherwise, we will conclude. And thanks everybody for joining. Oh, and if you have any questions or thinking about selling your business or hiring an investment banker or broker, please reach out to us. I'm happy to discuss that with you, whether it's looking at an investment banker or broker engagement letter, or it's helping with the whole deal here to help put together all the transaction documents. All right, seeing no questions here, I'm going to end it. Thanks everybody for joining.